A year-end rally, the Santa Claus effect, whatever you call it, equity markets tend to do well at the end of the year. But why is that? In this episode, we're separating myth from reality and looking at how you as an investor can make the most of it. Welcome to the now award-winning How to Invest series from Julius Baer. Traditionally, the Santa Claus rally refers to the stock market's history of rising over the last 5 trading days of the year and the first 2 market days of the new year. But speaking to our technical analysts here at Julius Baer, it would be better to think more broadly that wintertime here in the Northern Hemisphere does better than any other time. So cozy in as we take a look at the evidence. Statistics from the past 70 years show that markets, and that means almost all equity markets from the Hang Seng in Hong Kong to the DAX in Germany and the S&P 500 in the US, the later months of the year have done better than the middle months. And there is a big difference in winter returns when the market is in an uptrend compared to when it's in a downtrend. Take the S&P 500 for example. In uptrends, when markets have seen 12 months of positive momentum, the index has historically risen by 19.8%. Compare that to a decline of 1.46% when markets have been in a downtrend. But why? Well, it's a lot less to do with Father Christmas, sadly, and a lot more to do with market sentiment, as well as 1 or 2 other clear factors that actually start several months in advance, all the way back to the summer in the Northern Hemisphere, in fact. At this time of year, returns are often flattish, because let's face it, we're too busy thinking about holidays. And so too are many of the traders. As a result, the market is a little quieter and more relaxed. But by the time we get to the later part of the year, October onwards, things tend to pick up for a number of reasons. Holiday shopping. From Black Friday to Christmas, robust consumer spending reflects optimism about the economy and can drive investor confidence. Companies in retail and tech who benefit from this spending may see their stock price rise as investors anticipate better earning reports. Volumes are also on the up. To take advantage of tax opportunities, investors may sell underperforming stocks to offset capital gains taxes, usually earlier in December. Then there are the institutional investors, big investors like pension funds, who tend to adjust their portfolios by buying high-performing stocks to boost their year-end statements. On top of that, if investors feel optimistic about the upcoming year, due to improving economic conditions, anticipated interest rate cuts, or positive geopolitical developments, that positivity may also push the market higher in December. And I haven't even mentioned yet the general good holiday spirit around this time of year, which can spill over into the stock market. Of course, not every year we see a rally, and sometimes they don't happen. For example, in 2000, after the dot-com bubble burst, or during the global financial crisis in 2008, and more recently in 2022, when we were still reeling from the COVID pandemic. So what does this mean for you as an investor? Well, it certainly doesn't mean that you sell in May and go away. We can bust that myth straight away. It might sound good and have nice rhythm, but if you are to benefit from any upturn in markets, you have to be invested. If you're not, you run the risk of missing some of the very first and crucial days of a rally. Remember what we said all those episodes ago on timing the market? That's exactly what this is about, because if you miss just the best 50 trading days over a 40-year period investing in the stock market, you could reduce your total investment returns by a staggering 95%. The bottom line is, forget about Santa Claus when it comes to markets and making the most out of an end-of-year rally. Remind yourself of your investment goals, cut out the noise, and enjoy the holiday season. We'll see you next year for more from How to Invest. Like and subscribe to our channel to stay up to date with the latest.